In 1916, John D. Rockefeller was the richest man in America. He was also paying almost nothing in federal income tax, not because he was hiding money, because he had restructured how he owned it. His fortune sat inside holding companies, trusts, and charitable vehicles. The income those structures produced was treated differently than wages. The gains compounded without annual tax events. And when assets transferred, the timing was controlled, all of it legal, and all of it written into the code his lawyers helped shape. Most people look at a story like that and think it doesn't apply to them. That was a different era, different scale, different rules. Here's what changed. A lot of those same structures, scaled down, simplified, and formalized, are sitting inside the modern tax code right now, available to anyone who earns a salary, owns a home, runs a side project, or invests through a brokerage account. That gap between what you earn and what actually compounds isn't visible on a pay stub. It doesn't show up in a savings rate. It lives in the structure around the money. In this video, we're walking through 10 of those structures, legal mechanisms built into the tax code, employment law, and investing rules that change how fast money compounds and how much of it you actually keep. My name is Alex, and if you've ever felt like the math should be working by now, and somehow it still doesn't, then stay with this one, because by the end of this video, you'll be able to see exactly which part of the system is working against you. Name the specific structures that change that, and understand why nobody explained any of this in plain language until now. I'm going to walk you through all of it. Let's start with where your money lives. Most people think the goal is to earn more. And yeah, more income helps. But here's something that doesn't get nearly enough attention. Two people can invest the exact same amount of money and end up with completely different results. Not because one picked better stocks, but because of which account the money sat in. The tax code doesn't treat all accounts equally. It treats them based on purpose. And the accounts built for long-term saving get a fundamentally different set of rules than a standard brokerage account. Here's how the difference actually works. Put $1,000 into a normal taxable account, and the system taxes it at multiple points. Dividends get taxed each year. Gains get taxed when you sell. Every tax event pulls money out of the compounding base. The growth slows, not dramatically in year one, but quietly and consistently over decades. And you put that same $1,000 into a tax-advantaged account, and the story changes. Inside a traditional 401k, that's your employer-sponsored retirement account. Contributions go in before income tax is applied. The money grows untouched for years. Inside a Roth IRA, contributions go in after tax, but the gains and withdrawals come out completely tax-free. Two different structures, two different advantages, but both of them remove the friction that a normal account never escapes. And friction compounds too, just in the wrong direction. Here's a number worth sitting with. Someone who invests $500 a month starting at 28, inside a tax-advantaged account earning 7% annually, ends up with roughly $1.4 million by 65. The same $500 a month in a taxable account with modest annual tax drag lands closer to $1.1 million. Same person, same discipline, same market. The difference is around $300,000, and it came entirely from the container. Timing matters more than most people realize too. A smaller amount invested early inside the right account can outperform a larger amount invested later in the wrong one. That's not motivational language. That's just how compounding works when you remove the interruptions. And then there's the employer match. If your company matches contributions to your 401k, that is an instant and guaranteed return on your money before it ever touches the market. In 2026, the IRS contribution limit for a 401k sits at $23,500 per year. Most people don't get close to that, but leaving the match on the table is the most expensive habit in personal finance, and almost nobody talks about it that way. The system rewards money that goes in early and stays put. That's not an accident. Governments want long-term savers. Employers want stable, committed employees, so the incentives get built into the structure. The question is whether you're using them. So now you understand the container. Where money lives changes how it grows. But there's a second layer to this that most people never look at. It's not just about which account your money sits in. It's about what kind of money you're generating in the first place. Not all income is taxed the same, and the gap between the two main types is bigger than most people expect. When you earn a salary, the tax hits immediately. Your employer withholds it before the money ever reaches your account. But you earn, the government takes its share, and you invest whatever is left. That's the income layer. It's the layer most people live on for their entire working lives. Now compare that to the asset layer. When you own something that grows in value, a stock, an index fund, a piece of property, nothing is taxed while it's growing. The gain sits there, compounding untouched for months or years or decades. No tax event happens until you decide to sell. That delay is not a loophole. It's a structural feature of how the system was designed, and it gets better than just the delay. When you do eventually sell, long-term capital gains are taxed at a lower rate than earned income. In 2026, someone earning between $47,500 and $518,000 pays 15% on long-term capital gains. That same person could easily be paying 22 or 24% on their salary. Same person, on different types of income, different rate. Watch how this plays out over time. Two people spend 20 years building toward the same number. Person A earns a higher salary each year. Every raise gets taxed on the way in. The money that reaches his investment account is already reduced. Person B owns assets that rise in value over the same period: stocks, index funds, and a rental property. The gains don't get taxed each year. They stay invested and keep compounding on the full amount. Like after 2 decades, even if both of them put in similar dollar amounts, person B often comes out meaningfully ahead, not because he earned more, because his money compounded on a larger base for longer before the tax event ever happened. This is the structural difference between the two layers. Earned income is taxed on the way in at higher rates. Capital gains are taxed later at lower rates. The system was built this way deliberately. Governments want investment, business creation, nor in long-term capital formation. So they made ownership cheaper to hold than labor is to earn. Most people spend their entire careers on the income layer. Wealth tends to accelerate when part of your financial life shifts into the asset layer. That shift doesn't require a dramatic move. It starts with understanding which type of income the system actually rewards. And the next loophole takes that idea one step further. So the asset layer is more tax efficient than the income layer. You already know that. But here's where it gets strange. What if you never had to sell the asset at all? What if you could pull cash out of an investment without triggering a single dollar of tax? Most people assume the only way to access money locked in an asset is to sell it. Sell the stock, sell the property, pay the tax on the gains, and use what's left. That feels like the only logical path. And for most people, it is the path they take. But the system allows another one. Instead of selling, you borrow against what you own. The asset stays in place. It keeps growing. You get cash in your hand without a taxable sale ever happening. This is called a securities-backed line of credit when the collateral is an investment portfolio, and a home equity line of credit when the collateral is your property. A home equity line of credit, sometimes called a HELOC, lets you borrow against the portion of your home you actually own, the equity, without selling the house or triggering a tax event. Here's why this matters in practice. Say someone holds a $200,000 investment portfolio that has doubled in value over 10 years. He needs $40,000 for a business opportunity. If he sells, he realizes a gain and owes taxes on it, potentially $8,000 to $12,000 gone immediately, depending on his bracket. What remains goes to work, but on a smaller base. If he borrows against the portfolio instead, the $40,000 arrives as a loan, no taxable event. The full $200,000 stays invested and keeps compounding. He services the loan over time, which has a cost, but the asset base remains intact. That difference compounds, quietly, over the years. Now, this strategy isn't free money, and it's worth being clear about that. Loans have interest. Assets can lose value. The portfolio drops sharply while a loan is outstanding. The math gets uncomfortable fast. The risk is real, and it needs to be managed. But structurally, the insight is important. You do not always need to exit a position to use its value. The system was built to support credit markets backed by collateral. Banks prefer lending against assets because it's lower risk than lending against income alone. That preference created a mechanism that investors at every level can use, not just the ultra-wealthy. At the highest level, this becomes what's known as the buy, borrow, die strategy, where assets are never sold, borrowed against for liquidity, and passed on at death with the gains largely untaxed. Most people aren't operating at that scale, but the core mechanic is available long before you get there. Selling stops compounding. Borrowing doesn't. That's the whole idea. And speaking of assets that keep producing while you hold them, Real estate has its own built-in advantage that almost nobody fully understands. Real estate already benefits from the borrowing mechanism we just covered, but it has a second advantage built on top of that, one that's even more counterintuitive. The tax code lets you report a loss on a property that is actively making you money. That sentence sounds wrong. So let's walk through exactly how it works. The IRS assumes that buildings wear out over time. Roofs age, systems degrade, structures eventually need replacing. So the tax code allows property owners to write off a portion of the building's value each year to reflect that gradual deterioration. This is called depreciation. For a residential rental property, the IRS lets you depreciate the value of the structure over 27 and a half years. Not the land, just the building itself. Here's where it gets interesting. Take someone who buys a rental property for $350,000. The land is assessed at $70,000. So the depreciable building value is $280,000. Divide that over 27 and a half years, and you get a paper deduction of just over $10,000 every single year. Now say that the property generates $18,000 in annual rental income after expenses like mortgage interest, insurance, and maintenance. On paper, after the depreciation deduction, the taxable income from that property drops to around $8,000. Real cash came in. The tax bill shrank significantly. Both things are true at the same time. Sometimes the depreciation deduction is large enough that the property appears to produce no taxable income at all. Even when it's cash flow positive, the money arrived, the tax didn't. And this isn't accidental. The government wants housing built, maintained, and available to renters. Depreciation is the incentive structure designed to make property ownership financially attractive enough that people keep doing it. It acknowledges that buildings require upkeep and will eventually need replacement, so it rewards owners for staying in the game. The thing worth sitting with here is that depreciation is a paper loss on an asset that may be appreciating in real value at the same time. The property could be worth more every year, while the tax return shows it declining. And that gap between accounting reality and market reality is where the structural edge lives. Now, depreciation is one way the system rewards you for what you own, but some of the most overlooked advantages aren't tied to investments at all. They're sitting inside your employment contract, and most people walk past them every single day. Most people negotiate hard for salary. They research market rates, make the case for a raise, and track their income carefully. And that makes sense. But there's a part of compensation that often goes completely unexamined. And in some cases, it's worth more than the raise itself. Your employer benefits package is not a footnote. It's a second income stream with tax advantages built in that you cannot easily replicate on your own. Start with the most straightforward one. That if your employer offers a 401k match and you're not capturing the full amount, you're leaving guaranteed compensation on the table, not potential compensation. Guaranteed. A common structure is a 50% match on contributions up to 6% of your salary. On an $85,000 salary, that's $2,550 a year, your employer adds, simply because you participated. That money goes in pre-tax, compounds immediately, and most people either don't contribute enough to capture it fully or don't think about it as the return on investment that it actually is. Then there's the Health Savings Account, or HSA. To use one, you need to be enrolled in a high-deductible health plan. But if you are, the HSA is one of the most tax-efficient accounts in the entire code. Contributions go in pre-tax. The money grows tax-free. Withdrawals for qualified medical expenses come out tax-free. That's 3 separate tax advantages on the same account. In 2026, the contribution limit for an individual is $4,350, and for a family, it's $8,500. Most people treat it as a spending account for doctor visits. Used strategically, it functions closer to a stealth retirement account. Employee stock purchase plans are another one. Many companies allow employees to buy company stock at a discount, and sometimes 10 to 15% below market price. That discount is an immediate built-in return before the stock moves a single dollar in either direction. Here's the contrast that makes this concrete. 2 colleagues earn the same $91,000 salary. One takes everything as cash, pays tax on it, and invests what remains. The other maxes the HSA, captures the full employer match, and participates in the stock purchase plan at a 15% discount. After 5 years, the second person has deployed significantly more capital at better after-tax rates, without earning a single dollar more. The system rewards people who use these structures. Companies offer them because they want retention and alignment. Governments support them because they reduce long-term pressure on public systems. The incentives are stacked in your favor. Most people treat benefits enrollment as annual paperwork. It's closer to one of the highest return financial decisions available to a working professional, and it resets every single year. Now, all of these advantages assume you're living and working in the same expensive city where your employer is based, but that assumption is worth questioning. Here's a question worth sitting with. If you got a 30% raise tomorrow, but your rent, groceries, and transportation costs rose by the same amount, would your financial life actually change? The answer is no. Your number went up. Your breathing room stayed exactly the same. That's the mechanism behind geographic arbitrage. And it's one of the few advantages that doesn't require a new tax structure, a side business, or an investment account. It just requires a change of location. The idea is straightforward. Your income is set by the market you work in. Your expenses are set by the market you live in. For most of history, those two things were the same market, because your job required you to be physically present. That's no longer universally true. Remote work broke the link between where you earn and where you spend. And when that link breaks, something interesting happens. A software engineer earning $110,000 a year in San Francisco takes home roughly $72,000 after federal and California state income tax. Rent for a one-bedroom apartment in the city runs around $2,800 a month. That's $33,600 a year in rent alone, nearly half his after-tax income, before food, transportation, or anything else. That same engineer, working the same job remotely from Raleigh, in North Carolina, pays no state income tax on remote earnings at the same rate, and rents a comparable apartment for around $1,300 a month. His gross income hasn't changed. His financial position has shifted dramatically. The gap between income and expenses, the part that actually builds long-term ownership, just got significantly wider without a single promotion. Some people use that gap to accelerate investing. Others use it to pay down debt faster, build a cash reserve, or simply reduce the financial pressure that comes from living paycheck to paycheck in an expensive city. And some combine it with the earlier loopholes, routing the extra breathing room into tax-advantaged accounts or toward a first rental property. The point isn't that everyone should move. It's that location is a financial variable, and most people treat it as a fixed one. They optimize income, they optimize investments, but they never question whether the environment they're spending in is quietly undoing all of it. Sometimes the highest leverage move isn't earning more. It's spending less by changing the backdrop. And if geographic arbitrage is about changing your personal cost structure, the next loophole is about changing the cost structure of your income itself. When you earn a salary, the government gets paid first. Before the money reaches your account, taxes are already out. You work with what remains. That's the default structure for most working Americans, and almost nobody questions it because it's automatic. It just happens. But the tax code has a different set of rules for business income. And the difference in how those two types of income are treated is one of the most significant financial gaps that exists between people at the same income level. Here's the core mechanic. When money flows through a business, many of the costs required to produce that income are deducted before taxes are calculated, not after, before. Tools, software, equipment, a dedicated workspace, travel connected to the work, professional education, and services tied to delivering the product. Like these reduce the taxable base before the IRS sees a number. The income is the same. The path it takes changes the outcome. Let's make that concrete. A graphic designer earns $70,000 as a salaried employee. After federal income tax and self-employment considerations, he takes home somewhere around $52,000. A second designer earns the same $70,000 as a freelancer, operating through a registered business entity. He spends $8,000 on legitimate business expenses during the year, software subscriptions, a new monitor, a course, and travel to a client. His taxable income drops to $62,000 before the calculation even starts. The tax bill shrinks. More of the original $70,000 stays inside his control. That gap compounds over time because every dollar that doesn't leave as tax is a dollar available to reinvest. And this structure is not reserved for large companies or full-time entrepreneurs. Freelancing qualifies. Consulting qualifies. A side project generating occasional income qualifies. Contract work qualifies. In 2026, anyone earning self-employment income can establish a sole proprietorship, an LLC, or an S corporation, and begin treating legitimate business costs as deductions against that income. The threshold for getting started is lower than most people assume. Now, this doesn't mean everything becomes deductible. The IRS draws a clear line between expenses connected to producing income and personal consumption. That line matters, and it needs to be respected. But within it, the structural advantage is real. Money tied to generating value is treated differently from money spent on living. Most people accept the employee structure because it's the default. They never ask whether part of their income could travel a different path. And for a growing number of working professionals running some form of independent income alongside a regular job, that question is worth asking seriously. The cost structure of your income is a variable. Most people just never treat it like one. And once you understand how the path of money affects what you keep, the next question is how often you should be moving it around at all. There's a version of investing that feels productive. You research companies, you track performance, you move money when the signals look right, you're engaged, you're making decisions. It feels like you're doing the work. And there's a real possibility that all of that activity is quietly costing you more than doing almost nothing would. Here's why. Every time you sell an investment that has gained value, you trigger a taxable event. The gain gets realized, the IRS takes its share, and that portion leaves your portfolio before it ever has a chance to compound further. One sale might not feel significant, but active trading creates dozens of these moments every year, and each one is a small leak in the compounding base. Index investing works on a fundamentally different logic. Instead of selecting individual positions and rotating between them, an index fund holds a broad basket of assets and turns over very little of it from year to year. Low turnover means fewer sales. Fewer sales mean fewer taxable events. Fewer taxable events mean more of the growth stays inside the investment, untouched, continuing to compound on the full amount. The math on this is worth walking through. Say two people each invest $300,000. One trades actively, realizing gains regularly and paying an effective tax drag of around 1.5% annually on his portfolio. The other holds a low-cost index fund with minimal turnover and near zero annual tax drag. Should both earn an average of 7% gross return. After 30 years, the active trader ends up with roughly $1.6 million. The index holder ends up closer to $2.1 million. Same starting amount, same gross return. The difference, around $500,000, came entirely from friction. And there's a second cost in active trading that often goes unmentioned. It's not just the tax drag, it's the decision-making itself. Every trade is an opportunity to be wrong. And research consistently shows that the majority of actively managed funds underperform their benchmark index over a 10-year period. Individual traders fare worse on average. More movement, more decisions, more chances for the timing to be slightly off. The system quietly rewards capital that stays put. Unrealized gains are not taxed. Paper growth is free to compound indefinitely until you decide to sell. Patience isn't a personality trait in this context. It's a tax strategy. In 2026, the average expense ratio on a broad market index fund sits below 0.1% annually. That's the cost of doing almost nothing. And for most long-term investors, almost nothing turns out to be remarkably hard to beat. As money grows, though, a new problem starts to appear. It's not about returns or taxes, it's about exposure. And the next loophole is about protecting what you've already built. Most financial conversations focus on growing money, how to earn more, invest smarter, reduce tax drag, and compound faster. All of that matters. But there's a risk that quietly grows alongside the money itself. And most people don't think about it seriously until something goes wrong. Legal exposure. When everything you own sits under your personal name, every risk you take in business or investment life is connected to everything else you have. A lawsuit from a tenant, a business dispute that escalates, a liability claim from a client. In the right circumstances, any of those can reach your personal bank account, your investment portfolio, or your home. Not because you did anything wrong necessarily, just because there was no legal boundary between the activity and your personal assets. The system offers a way to draw that boundary. Legal structures like limited liability companies, commonly called LLCs, and holding entities create a separation between you as an individual and the activities or assets you own. When a rental property sits inside an LLC, a claim against that property is largely contained within the entity. It doesn't automatically flow through to your personal finances. When a business operates inside its own legal wrapper, a dispute inside that business lives inside that container. Think of it like compartments on a ship. If one compartment floods, the others stay sealed. Without the compartments, a single breach sinks everything. Here's how this plays out in practice. A landlord owns 3 rental properties, all under his personal name. A tenant is injured on one of the properties and files a lawsuit seeking damages that exceed his insurance coverage. Because everything is held personally, his other properties, his brokerage account, and his personal savings are all potentially reachable in the judgment. A second landlord owns 3 identical properties, each inside a separate LLC. The lawsuit is contained to the entity that holds that one property. The rest of his portfolio sits behind a legal wall. Same properties, same lawsuit. Very different exposure. The cost of setting up a basic LLC varies by state, but typically runs between $50 and $500 in filing fees, with annual maintenance costs that are generally modest. The protection that structure provides against a single adverse legal event can be worth multiples of that, many times over. And this isn't about hiding assets or obscuring ownership. Everything is registered, reported, and transparent. It's simply about understanding that ownership and exposure don't have to be the same thing. The system allows you to own something without having your entire financial life attached to it. Most people build for years before thinking about structure. The smarter move is to think about it early, before the risk has time to arrive. And the final loophole ties all of this together. It doesn't require a new account, a legal entity, or a change of location. It just requires one deliberate decision about timing. Every loophole we've covered so far involves doing something: opening the right account, structuring ownership correctly, borrowing instead of selling, routing income through a business. This last one is different. It's about deliberately not doing something. And in the right circumstances, that restraint is worth more than almost any active move you can make. The tax code taxes gains when they are realized, not when they appear on paper. Not while the asset is growing, only when you sell. That single rule creates a quiet but powerful advantage for investors who understand it and build their behavior around it. Here's the mechanism. An asset rises in value by $40,000 over 5 years. While it's rising, nothing is owed. The full amount stays invested and keeps compounding. The moment you sell, the gain is realized, the tax event triggers, and a portion leaves the portfolio permanently. That portion no longer compounds. It's gone from the base. And now multiply that across dozens of decisions over a 30-year investing career, and the difference becomes significant. Every unnecessary sale is a permanent reduction in the compounding base. Every delayed tax event means more money staying invested for longer. This gives investors a form of control that salaried earners simply don't have. A salary is taxed the moment it arrives. There is no choice in the matter. An investment can sit and grow for years before any tax obligation is triggered, and the decision of when to trigger it belongs entirely to you. That timing can be used strategically. Some investors realize gains deliberately in years when their income is lower, keeping them inside the 0% long-term capital gains bracket. In 2026, a single filer with taxable income below $47,025 pays no federal tax on long-term capital gains at all. 0. Someone who plans a sabbatical, takes time between jobs, or has a temporarily lower income year can use that window to realize gains at a rate most people never access. Others simply avoid unnecessary trading, letting positions run for years rather than constantly rotating. Not because they're being passive, but because every hold is a deliberate choice to keep the full compounding base intact. The asset hasn't changed, the timing has. And over long periods, timing affects outcomes in ways that feel almost unfair once you see them clearly. Here's the simplest way to frame it. Growth that stays inside an investment keeps working. Growth that gets realized as a taxable gain stops working on the portion that leaves. The system taxes events, not time. So one of the most powerful things you can do as an investor is control how many events you create. Patience isn't passive. It's a strategy. And it's one of the few strategies in personal finance that gets more powerful the longer you apply it. Here's what all 10 of these have in common. None of them requires a higher income. None of them requires insider access or a team of lawyers. They require understanding how the system actually scores the game, and then making decisions that match those rules instead of ignoring them. The pattern underneath all of it is the same. The system taxes events, not time. It rewards ownership over labor. It favors money that stays put over money that moves constantly. It gives structural advantages to people who understand which container their money lives in, how it's classified, and when a taxable moment gets triggered. Most people optimize the obvious variables. Income, savings rate, investment returns, those matter. But the people who pull ahead over 20 or 30 years are usually doing something quieter. They're removing friction, delaying tax events, separating exposure from ownership, letting compounding run without interruption. The question worth sitting with is this: not whether you're working hard enough, but whether the structure around your money is working as hard as you are. Because if it isn't, that gap doesn't close on its own. There's a related question that doesn't get asked enough, though. All of these loopholes assume the rules stay fixed. But tax codes change, contribution limits shift, and new structures appear. So the real skill isn't memorizing today's rules, it's learning how to read them. That's worth exploring next.